On October 31st, 2021, the UN Climate Change Conference in Scotland opened with the conference president, Alok Sharma of the United Kingdom, calling for world leaders to, quote, consign coal to history. In many ways, this sentiment is nothing new. Environmental groups and politicians looking to burnish their image for fighting climate change have been labeling coal to be public enemy number one for some time now. That's because, of course, burning coal produces more carbon dioxide emissions than other fossil fuels like natural gas. The only sticking point at last year's COP26 climate summit was supposed to be that countries like India and China were going to need more time to phase out coal use. Now, Mr. Sharma even reportedly choked back tears when India demanded a more watered-down commitment to the timetable for reducing coal use in the final draft of the COP26 statement from the conference. Well, here we are, just 7 months later, and coal is suddenly the belle of the proverbial ball again. And not just in China and India, but in Europe and the US as well. In the UK, the very country that hosted the COP26 conference last year and led the drive to consign coal to history, the government has now set a deadline of July 7th to decide if it will go ahead with plans to open a new coal mine in Cumbria, a beautiful region of northwest England. This would be the first new coal mine in the United Kingdom put into operation in 3 decades. And reports suggest the government is leaning in favor of approving the mine. And the German government, long one of the most aggressive in Europe in embracing climate change goals, is actively working with major utilities there, like RWE, to reactivate coal-fired facilities that have already been deactivated, as well as delaying the planned decommissioning of operating facilities. Now, Italy is apparently considering a similar move to Germany. And consider the port of Richards Bay. Richards Bay is located right here in South Africa's eastern coast, and it's a major export terminal for coal produced there. Now, in 2021, about 86% of coal shipped out of Richards Bay was destined for Asia, and only around 4% went to Europe. However, lately, there's been a surge in shipments around the Cape of Good Hope, making their way to Europe. This chart is based on ship tracking and geolocation data, and you can clearly see the ramp in coal exports to Europe starting last summer and reaching a multi-year record high here in March. We don't even have the final data for April just yet, but it's shaping up to be another record or near record month for coal exports. Listen, I know the first reaction is to assume that coal's resurgence is entirely a function of Russia's invasion of Ukraine this year and the need to replace Russian supply. Now, many politicians, I must warn you, want you to believe that, because the reality is far more sinister and damaging economically. And I'm not saying that Russia's invasion and related sanctions don't play a role. After all, in 2021, Russia exported 187 million tons of thermal coal. Now, that's coal used in power plants, which is equivalent to about 18% of global trade in the commodity. However, as I just showed you, the big surge in coal exports to Europe started late last year, months before there were any hints of Russia's planned invasion in the Ukraine. Indeed, for a dead fuel about to be consigned to the dustbin of history, coal seemed to have an awful lot of life left long before the Russian invasion. In 2021, the world generated more power from coal than ever before in history, an increase of 9% from 2020 levels. And while demand for coal from India and China rose last year by about 12% in both cases, the real boom was in US and European Union, both regions where coal demand soared by more than 20% last year. Now, if you're like many investors, you're probably wondering, why is the dirtiest of all fossil fuels gaining so much market share when the mainstream media and political leaders from all over the world and various sides of the political spectrum have been telling you coal was dead for years? Why are oil and gasoline prices soaring when not long ago the headlines all seemed to be about the end of oil and peak oil demand, and how quickly technologies like electric vehicles, advanced batteries, and wind and solar power were bringing the age of fossil fuels to a rapid conclusion? Hi, my name is Elliot Yu, and I'm co-founder of Energy and Income Advisor, an energy-focused investing service I started almost 10 years ago now that's quickly and quietly grown to serve thousands of investors around the world. In this short video presentation, I'm going to answer those questions and more in the simplest terms possible. And I'm going to be presenting a lot of facts and evidence. In particular, I'll explain why Vladimir Putin and the Russian invasion of Ukraine aren't the root causes of the current energy mess. It's actually far worse than that. The widely touted idea that oil, natural gas, even coal are dead fuels that will quickly be replaced by clean, renewable energy technologies like solar and wind. The idea that the internal combustion engine will be phased out by 2030 or 2035 or so and replaced entirely by electric vehicles. These ideas have been completely and entirely discredited. Listen, I must warn you that some of the predictions and facts I'm going to present might seem extreme, even apocalyptic. But as I'll cover in this video in just a few moments, the truth is that most of these trends are already underway. The bad news is that there's nothing you or I or any government or politician can do to stop this quickly or painlessly. It's just too late, and the situation has developed far beyond the point of no return. Because they've gone on for so long, and for much of that time seemed pretty innocuous on the surface, the negative side effects have been able to build quietly to a scale that's extremely dangerous. However, watch this video through to the end, and I'll explain 5 simple steps you can take to help protect yourself from the coming market storms, and even benefit financially from the dramatic shifts that are already underway. So let me start with this. This chart shows 3 different natural gas price benchmarks: Henry Hub on the US Gulf Coast, Netherlands Tidal Transfer Facility, or TTF, in Europe, and the Japan-Korea LNG Cargo Index. And I'm showing these charts since early 2020. Now, US natural gas prices rose over $6 a million BTUs last October. That's the highest level since 2008. And over $8 a million BTUs this spring. However, what's truly shocking is the surge in European and Asian prices starting last year. The key Netherlands TTF benchmark reached highs above $40 a million BTUs in early October 2021 and rallied close to 60 by December 21st of last year, a record high and up about 9-fold from where European gas prices were trading back in early January of last year. And then this year, in the immediate wake of the Russian invasion, European gas prices went even higher, soaring close to $70 a million BTUs. That's a whopping 15 times the price of the exact same natural gas at that time in the United States. In Asia, prices jumped over $35 a million BTUs in mid-October last year and near $50 on a few occasions this year. So you might be wondering, what's causing this unprecedented surge in European and Asian natural gas prices? As I mentioned a little earlier on in this presentation, it's not solely due to the Russian invasion of Ukraine, which started on February 24th, 2022. Now, European energy prices started rising steadily more than a year ago, and they spiked to record highs last September and October, nearly 6 months before the Russian invasion. Well, to put it simply, soaring European gas prices are the direct result and consequence of the region's failed efforts to force a rapid transition away from traditional sources of energy like oil, natural gas, and coal in favor of renewables like solar and wind. Again, I know that Europe is widely portrayed as the most successful region in terms of meeting its targets to reduce carbon emissions by 2030. the regions that's furthest along in the so-called energy transition away from fossil fuels. However, when you examine the facts and evidence as I have, I believe you'll see that popular, widely repeated narrative vanishes to be replaced by an increasingly grim and dangerous reality. Again, I know this is going to sound like heresy to some of you, given the narrative out there in the mainstream media. However, the dirty little secret is that wind and solar just are not reliable. You see, power generation from wind and solar facilities ultimately depends entirely on the weather. When it's not windy, power output from wind power facilities will decline dramatically. And when it's cloudy, solar power output will drop. The timing of these peaks and lulls isn't always convenient. The problem is that while it is possible to store power, there is no cheap way of doing so for long enough or on the scale needed to meet electricity demands for a country like Germany. Don't take my word for it. Look at the mix of wind, solar, and other power sources in the German energy grid since the beginning of 2020. In particular, look at the black line on this chart. That's German wind power output in gigawatt hours. Look at how wind power output declined dramatically from here in October 2020, straight through the winter, spring, and into the summer of 2021. In fact, in October 2020, wind accounted for a whopping 29% of total German power generation, plummeting to a low of 10.7% of the German power supply in June 2021. Now, Germany has aggressively expanded wind power generation capacity over the past 5 years, so this decline is entirely due to lower than average wind velocities across much of Europe in the first 9 months or so of last year. So what do you do when you lose your most important source of electric power? Now, what Germany did was to step up its reliance on fossil fuels for electricity generation. In June 2021, for example, when German wind power reached its lows for the entirety of last year, the dirtiest power source of all, and again, I'm talking about widely vilified coal power, accounted for almost 27% of German electricity supply. Meanwhile, even as European gas prices started to take off last summer, Germany could not decrease its reliance on expensive gas-fired power plants, not if the nation wanted to keep the lights on. So gas climbed from about 9.5% of Germany's power supply in August 2021 to above 17% in both November and December of last year. And so what's happened since the Russian invasion, as Germany and the rest of Europe fret over the threat made explicit in recent days for Russia to literally cut off Europe's natural gas supply? Well, the combination of that threat, a shortage of gas and storage, and those runaway European gas prices that I just showed you have forced Germany to cut gas use in its power plants. But is it wind and solar that have filled the gap? Absolutely not. In March of this year, the last full months for which we have data, wind accounted for 18.92% of the German power supply, which is actually down from 23.66% in the same month 1 year ago. Meanwhile, coal's share of power output is at 37.62%, up almost 15 percentage points from the same month in 2021. Do you remember those charts I showed you of coal exports out of Richards Bay in South Africa? Now that's a direct result of these trends. The result of this mess? Well, see for yourself. This chart shows German baseload electricity prices in euros per megawatt hour. At the end of 2020, the cost was about 50 euros per megawatt hour, jumping to around 260 euros by early October last year, and 500 euros per megawatt hour in early March of 2022 of this year. A tenfold increase in just over a year. Power prices in Europe's largest economy recently soared to a record high, surpassing the level reached at the height of the 2008 energy crisis, a time when Brent oil prices breached $147 a barrel. And just remember that Germany already had the second highest household power prices in Europe at approximately 37 US cents per kilowatt hour on average in the second half of 2021 before the Russian invasion. To put that in perspective, the US average residential electricity price is just under 14 US cents per kilowatt hour as of early this year. And that said, this isn't uniquely a German problem. You see, Europe as a whole has followed the German lead by encouraging the rapid adoption and development of intermittent renewable power sources, mainly solar and wind. And like Germany, that's rendered the region more susceptible than ever to weather-related issues. Moreover, also like Germany, these policies have led to higher electricity prices and the need to maintain significant shadow capacity. Now that's idle natural gas-fired power plants that can feed in power when the wind isn't blowing and the sun isn't shining. And as I just showed you, European imports of coal are soaring as the region struggles to ease reliance on natural gas while providing a backup baseload power source that can truly offset the dangerously intermittent output from wind and solar facilities. As a result, Germany, long considered a leader of the energy transition to alternatives, is actually seeing a sizable increase in carbon dioxide emissions. Now, this chart shows the German government estimates for carbon dioxide emissions from the energy, transport, buildings, and agricultural sectors of the economy, going all the way back to 1990. I've also included a bar here showing the government's target for emissions reductions by 2030. As you can see, in 2021, German emissions of CO2 equivalent rose 4.5%, mainly due to a 12.3% increase in emissions from the energy sector, the direct result of the country's imploding renewable energy transition strategy. Indeed, late last year, before the Russian invasion, Economy Minister Robert Habeck of the German Green Party, which is part of the coalition government, indicated that Germany would probably miss its targets for emissions reductions in 2022 and 2023. And here's what's even worse. Between 2010 and 2020, German carbon emissions fell a total of about 22.1%, which is equivalent to a reduction of about 2% annually. To meet its 2030 goals, Germany would need to reduce its carbon emissions 42.5% from 2021 to 2030, a reduction of a little over 4% annualized in the next 9 years. That's double the pace of reductions in the past decade. And given that emissions are likely to rise in 2022 and 2023, that goal is quickly moving from wildly ambitious to next to impossible. Of course, Russia accounts for about 40% of the European Union's natural gas supply. So the region's increased reliance on renewables also implies a massive loss of energy independence. A loss of energy independence that Russian President Vladimir Putin has been able to leverage to pay for the war in Ukraine. And make no mistake about it, leaving aside the rhetoric out of European capitals of late, Russia still holds Europe's economy very much in hand. When Russia demanded that its European customers pay for gas in rubles rather than euros or US dollars, a move that would help prop up the value of the Russian currency, European leaders balked. So just last month, Russia cut off gas supply to both Poland and Bulgaria over their refusal to comply, leaving the rest of Europe scrambling for a face-saving compromise to meet Russian demands while technically not violating sanctions the EU has imposed on Russia over the Ukraine invasion. Listen, Europe's energy crisis is bad news, and it's already having severe political, financial, and societal consequences. Of course, Russia's invasion of Ukraine is a tragedy. However, the hard truth is that Europe's unrealistic energy policies and pie-in-the-sky mandates have literally financed Putin's aggression. Unfortunately, Europe doesn't have the monopoly on naive government policies towards energy, and the disastrous consequences stretch far beyond EU borders and far beyond natural gas and coal. And that brings me to the topic of electric vehicles, or EVs as they're widely known. Now, at the end of March this year, President Joe Biden addressed a group of reporters at the South Court Auditorium of the Eisenhower Executive Office building in the nation's capital. The topic: Russian President Vladimir Putin's decision to invade Ukraine and the consequent jump in gasoline prices. The president covered a lot of ground that afternoon. However, one of the main steps he's recommending and has suggested on multiple occasions to lower energy costs is electric vehicles. So the president said this, quote, "But most important, the most important thing my plan would do right away is save your family money. And here's what I mean. Under my plan, which is before Congress right now, we can take advantage of the next generation of electric vehicles that a typical driver will save about $80 a month from not having to pay gas at the pump." So let's step back for a moment and consider the best-selling vehicle in America, and that is the Ford F-150 pickup truck. Ford makes a gasoline-powered version of this truck, and the very base model in 2022 cost $29,640. Ford is also introducing a brand new F-150 Lightning, which is an all-electric model for 2022 that has a base price of $39,974. Now, due to supply chain disruptions and shortages of components, it's pretty tough to find a new car available for purchase these days. And good luck finding the base model F-150 in either the gasoline or the all-electric Lightning version. However, let's assume you could purchase either one of these new trucks. If you're like most Americans, you're looking to finance these trucks. So I plugged in some basic data into an online auto loan calculator. Let's say you buy the gasoline-powered F-150 truck. You have good credit with a FICO score of 680 plus, and you can put $5,000 down, or you can trade in your existing vehicle for that same $5,000 down payment. I assumed a 72-month loan to bring down those payments as low as possible. Your monthly payment, as you can see here, is $417. Now let's do the same calculation for the F-150 all-electric Lightning pickup. Well, as you can see here, your monthly financing cost jumps to $592 per month, an increase of $175. And keep in mind that interest rates are rising, and that's driving up the cost of financing a new or used car purchase. So let me ask you this. Is the average American going to spend an extra $175 a month to save $80 a month at the gas pump? Do you think the best way to save money is to go out and buy a $40,000 or $50,000 new electric car? I don't think so. And it's just not the F-150 I'm talking about. According to Kelley Blue Book, the average cost of an electric vehicle in America this year is $56,437, which is more than $10,000 more expensive than the average new car sold in America. Even with the tax incentives, which get extremely costly for taxpayers as the number of EVs sold rises, most calculations show that you'd need to drive a car for 10 or 15 years or more for the EV to actually save you any money. And that's under a best case scenario. And of course, those calculations apply only to new cars. Far more used cars change hands in this country every year, and the overwhelming majority of used vehicles in America are powered by gasoline. I just did a quick search on CarMax for used SUVs at locations within 500 miles of where I live here in Florida, and that search returned 3,376 matches. I did the same search for EVs, not just SUVs, but any kind of EV, and found just 23, with the cheapest option being a 2020 Tesla Model 3 Standard Range Plus model with about 39,000 miles on it and at a price of $45,998. Of course, EVs will likely over time come down in cost while performance, such as range on a single charge, improve. In turn, that might one day reduce a nation's reliance on crude oil and imported crude oil. Yet EVs don't reduce reliance on commodities, natural resources, and in many cases, imported resources at all. Take a look at this chart. This is a chart of cobalt prices traded on the London Metals Exchange, or LME, since the beginning of 2019. And as you can see, the price of the silver gray metal has soared more than threefold since the lows there in the summer of 2019. Let's put that in perspective. The low for oil prices in the summer of 2019 was about $50 a barrel. So the price of oil has barely doubled to a little over $100 a barrel since the summer of 2019. Cobalt is also a necessary element for producing batteries used in electric vehicles. And ramping up global EV production to the levels envisioned by many of the published targets for EV adoption out there would require a lot more cobalt. How much more cobalt, you might ask? Well, the International Energy Agency recently took a stab at answering that question. In a special report titled "The Role of Critical Minerals in Clean Energy Transitions," their sustainable development scenario contemplates the level of carbon dioxide emissions reductions needed to meet targets in the so-called Paris Climate Accord. To meet that target, global demand for cobalt would rise from 21,000 metric tons in 2020 to 441,000 tons in 2040, a 21-fold increase in demand for the metal in the space of just 20 years. That's 21 times more of a metal that's already tripled in price over just the last 3 years. And where will the world get all this cobalt? Well, let me show you. This country right here in Central Africa is the Democratic Republic of Congo, home to more than 60% of the world's supply of cobalt. The DRC, as it's called, ranks 147th out of 180 countries in the Wall Street Journal Heritage Foundation Economic Freedom Index. Transparency International ranks the DRC 161st out of 180 countries on its Corruption Perceptions Index. In short, the DRC is not an easy place to do business. In recent years, Glencore, a Swiss company that owns a massive Katanga mine in the DRC, settled a lawsuit with the country's state-owned mining firm to restructure the debt associated with this operation. And back in late 2018, Congo declared cobalt strategic, nearly tripling the royalty rate miners pay on the metal. And unfortunately, it's not all about cobalt and the Congo. I took this chart directly from the same IEA report I talked about earlier. The top half of this chart shows the content of a long list of minerals including cobalt, graphite, lithium, rare earth elements, and copper in both conventional internal combustion cars and electric vehicles. As you can see, the total mineral content of a conventional car is around 40 kilograms. That's about 88 pounds, compared to well over 200 kilograms, and that's about 441 pounds or so, in an electric vehicle. To meet the IEA's sustainable development goals would require a 21-fold increase in cobalt supply, as I just mentioned, alongside a 43-fold increase in lithium production, a 41-fold increase in nickel output. Manganese demand jumps 16-fold, 28 times for copper, 25 times for graphite, and a 15-fold increase in supply of so-called rare earth elements. Now, rare earth elements are a group of about 17 elements, and China accounts for about 57.5% of global production. China is even more dominant in the global production of some of these heavier rare earth elements like dysprosium and terbium, which are widely used in electric vehicles, as well as strategically important defense technology applications. And the issue of mineral supply is not just an issue for the future or 2040 when EVs become more popular. It's a problem right now. Bank of America recently estimated that the raw materials costs for an average conventional car in Europe are up about 25% year to date to around 3,700 euros. That's about 3,900 bucks. That's pretty bad. However, the raw materials costs for EVs are up even more, by 50% so far in 2022 alone, to more than 9,000 euros per vehicle. That's about $9,500. To offset these costs, of course, automakers need to raise prices for EVs or watch their profit margins evaporate, which reduces the economic viability of EVs compared to cheaper and less resource-intensive conventional cars. Alternatives to that include mandating consumers buy EVs, which isn't particularly popular politically, or ramping up costly subsidies, government spending that's tough to stomach in the face of soaring inflation, slowing economic growth, and increased defense spending for many European countries and the United States in light of the Russian invasion of Ukraine. Indeed, at the end of April, Democratic Senator Joe Manchin of West Virginia, a key swing vote in the United States Senate, called federal tax credits for electric vehicles, quote, ludicrous, effectively killing any prospects for House Democrats' plan to put together a much expanded package of electric vehicle credits. Well, you see, that in a nutshell is the problem. For some time now, the US and many foreign governments have been focused on adopting policies and mandates aimed at reducing the importance of fossil fuels. Some governments have announced the phase out of internal combustion engines. Others have put a price on carbon emissions or subsidized alternative energy sources like solar and wind. And many have offered tax subsidies or other incentives for buying electric vehicles. Meanwhile, here in the US, the Biden administration put a halt to new drilling on federal lands, which he later reversed, while several key pipelines proposed in the US have been, quote unquote, killed by environmental activism. The aim of all this, in one form or another, is to reduce the appeal of investing in new projects to produce, move, or store oil and gas, while increasing the financial appeal of renewable energy projects. Well, global energy companies have heard that message, and capital spending across the global energy supply chain has collapsed in recent years. This chart shows total capital spending in the energy industry since 2010. Much of this CapEx is directed at oil and gas exploration and development activity. In total, I've included data from 16 large integrated producers and 34 North American exploration production company or E&Ps. As you can see, capital spending from these companies was around $430 billion per year back in 2013 and 2014, yet last year, total CapEx came at just over $200 billion. And the early read is that figure isn't expected to rise much this year either, despite soaring oil and natural gas prices. So let me ask you this. Is it really any wonder that according to Rystad Energy, global discoveries of new oil and gas fields worldwide have dropped to the lowest level since the 1940s? Global producers are finding less oil and gas these days than they have in 70 years. Very recently, some governments have started to alter course slightly in the wake of the Russian invasion of Ukraine. The UK was once energy independent, but new projects in the North Sea have dwindled in recent years, with environmental groups and activist investors pushing these companies to cut spending and invest in alternative energy technologies instead. Royal Dutch Shell, for example, planned to develop a large gas field located in the central North Sea, about 170 miles east of Aberdeen, Scotland. Called Jackdaw, this project was initially envisioned to produce around 215 million cubic feet of gas per day, with a subsea pipeline carrying that production back to existing platforms in the region. Approval of the project was initially delayed by the COVID outbreak. Then, last summer, the UK regulator denied Shell's development plan for the field, effectively delaying, or more likely, killing the project. Then, a small energy company called Siccar Point was forced to pause development of its Cambo oil field in the North Sea amid intense environmental opposition from groups like Greenpeace. Shell, an investor in the project, decided to withdraw from the deal late last year rather than face another expensive rejection from UK regulators. Greenpeace even sent out a tweet applauding Cambo's demise. Their tweet included the hashtag #JustTransition, which is part of a movement to invest only in renewable energy and stop approving any new oil, gas, or coal developments anywhere in the world. Following the Russian invasion, the UK government is now turning to the very same companies for help in developing new UK domestic oil and gas resources. The government even plans to offer a new licensing round later this year, opening up new acreage for development in the prolific North Sea region. Boris Johnson's Conservative government has also pivoted in other ways lately, announcing a new energy security strategy that targets tripling the UK's installed base of nuclear power plants by 2050. Listen, I applaud some of these shifts. However, I must warn you, it's just too little, too late. Too late at least to avoid some of the devastating consequences of empty rhetoric like just transition and naive environmental activism. Even if projects in the UK's North Sea are quickly approved and investments sanctioned by the companies, it will take years for significant new oil and gas to flow. And progress towards a more balanced energy policy that prioritizes economic, social, and scientific realities over environmental slogans and grandstanding is halting at best. Just consider the US and EU recently announced an agreement aimed at helping the continent wean itself from Russian energy supply, particularly nat gas. One centerpiece of this agreement, unveiled on March 25th of this year, is a US promise to work with international partners to ensure additional liquefied natural gas, or LNG, volumes of 15 billion cubic meters of natural gas for this year, with, quote, expected increases going forward. As part of this deal, both the US and EU pledged to support a favorable regulatory environment that would allow for the construction of new LNG liquefaction, these are gas export terminals in the United States, and regasification terminals, these are LNG import terminals, on the other side of the Atlantic. However, look behind that rhetoric for just a moment. At the same time, US regulators just released a new draft regulation that will require US LNG export terminals to obtain an environmental impact statement rather than an environmental assessment before applying for permits. Doesn't seem like much, right? What does that even mean? Well, environmental impact statement takes an average of 794 days to obtain rather than just 350 days or so for environmental assessment. If that rule is finalized, and I sincerely hope that it's not, it would lengthen permitting time for new LNG terminals by more than a year. Look, the hard truth is years of underinvestment in conventional energy production projects and years of government discouragement of viable new conventional energy projects will take many years to reverse. And that means that global oil and gas supply will struggle to keep pace with still rising demand. Some countries will still be dependent on Russian supply for at least the next 5 to 10 years, and commodity prices will need to remain elevated to make it economically viable to produce enough supply to meet growing global demand. So I ask you, will you act now to both protect and grow your wealth amid this looming and growing energy crisis? I hope so. And that's why I've created this video presentation today. Not only to discuss what's already happening, but even more important, to outline in the simplest terms possible a handful of specific profit moves I'm recommending to my readers of my Energy and Income Advisor service right now. So let's get started with those. Profit step number 1, real yield. Listen, if you're like me, you're probably concerned about the stock market right now, the health of the US economy, and eye-popping inflation, the likes of which we haven't seen in 40 years. And you might also be wondering about income. After all, the S&P 500, even after the recent decline, still yields a paltry 1.5%, which looks even less impressive in light of the current 8.5% annual inflation rate. Meanwhile, the 10-year US Treasury bond yields just over 3%, up from under 1.2% last August, but still less than nothing, with the US dollar losing more than 3.5% of its purchasing power over just the last 4 months alone. My research shows that we're currently in a market cycle similar to 1968 to 1982, a 14-year period when bonds and stocks both generated negative real inflation-adjusted returns. So where can investors go for income these days? Well, one of the only asset classes that helped investors survive the inflation of the 70s and generate real after-inflation income was commodities and other real assets. And select US shale producers have emerged as one of the only corners of the stock market that could both protect your assets from the ravages of inflation over the next few years and generate a steady stream of dividend income. Right now, I'm tracking a handful of shale producers in the US that have adopted a new business model focused on cash flow over production growth. The best of breed can run their businesses and generate positive cash flow even with oil around $30 a barrel, or nat gas under $3 a million BTUs, compared to $100 plus oil and US gas prices as high as $8 plus recently. One of our favorites is a producer in the Permian Basin of Texas, primarily an oil producer, that paid a whopping $7.38 in dividends for the most recent quarter alone, a payout which annualizes at the current stock price to nearly an 11% yield. And just recently, we added a US natural gas producer with acreage in the Haynesville Shale of Louisiana, the Eagle Ford Shale in southern Texas, and the Marcellus Shale field in Appalachia. Even if natural gas prices only average around half the current level over the next 5 years or so, we can see this stock generating some $9 billion in free cash flow over that same time period. The company just paid a $2.34 quarterly dividend, which equates to more than a 10% annualized yield, which we believe is rock solid even at lower natural gas prices, and more likely will see significant growth over the next few years. And that brings me to this, profit step number 2, buy the Energy Contrarians. Listen, as I just outlined, there's been a tremendous wave of investment, alternative energy, clean tech, and so-called ESG flavored companies in recent years. While most traditional energy companies have dramatically slashed capital spending on new oil and gas projects, leading to a collapse in new field discoveries and an acceleration in the global base decline rate. But there's a big difference between most and all. You see, a small handful of international energy companies of all shapes and sizes have actually taken advantage of the decline in energy prices after mid-2014. They've taken advantage of the lack of interest in new oil and gas field exploration and development to go the other way. While most have dramatically cut capital spending and planned a gradual decline in actual oil and gas production, these companies have ramped up spending and are, over the next few quarters, bringing brand new oil and gas production projects on stream. Even better, due to the lack of exploration and development activity, these contrarian producers were able to negotiate rock bottom prices for key oilfield services used to explore for and develop new fields. And they've been able to strike sweetheart deals with governments and countries with significant oil and gas reserves, allowing them to recover their development costs at a rapid pace and begin enjoying an unprecedented flood of free cash flow. Free cash flow they're using to pay higher dividends, pay off debt, and buy back stock to create real value for investors. These companies may also be one of the only things separating the US and global economies from a devastating hydrocarbon supply shortfall over the next few years. Their competitors will be scrambling to catch up. And there's more. Profit step number 3, energy technology. The energy industry goes far beyond producers. I'm currently recommending my readers buy a handful of energy technology companies that own the technologies needed to produce more oil from aging fields and to optimize production from complex, tough-to-tap reserves. And how about this? Profit step number 4, the LNG boom. Liquefied natural gas, or LNG, is nothing more than natural gas, which is methane, that's been supercooled to the point that it's in liquid form that can be loaded onto an LNG carrier. Now, an LNG carrier is a ship capable of transporting LNG, much like a tanker transports oil. When gas is supercooled to a liquid, it also takes up less space. Roughly speaking, a beach ball sized quantity of natural gas shrinks to the size of a ping pong ball when supercooled to form LNG. LNG is one of the simplest ways Europe and other major gas importers can meet their energy needs, reduce crippling electricity prices, and make progress towards their environmental goals, all while reducing and eventually eliminating dependence on imported Russian gas. The bad news, it won't happen immediately, as there simply are not enough LNG export terminals in the world to supply the gas needed to replace Russian volumes. However, the good news is that, as I outlined a little earlier, the recent crisis has sparked some progress. One of our favorite ways to play this massive LNG trade boom is via an often overlooked US company. This company's turbo compression machinery is installed in more than 90% of existing global LNG liquefaction terminals. Management has been guiding higher estimates for orders and LNG project awards it expects over the next 2 to 3 years as the world struggles to replace politically toxic Russian volumes. Even better, the sale of shares from a former parent firm has acted as a headwind for the stock over the past 2+ years. But with those sales now finally wrapping up, we can see this cheap stock surging 50% or more by early next year. In just a few moments, I'll explain how you can gain immediate access to our latest research on this overlooked energy technology gem. However, first, let me tell you about one more profit step we're recommending. Profit step number 5, irreplaceable assets. And last but not least, you've probably heard or read about the cancellation of key US oil and gas pipeline expansions in recent years. Pipelines that would deliver natural gas from Appalachia to the gas-hungry Northeast. Pipelines that would deliver vital oil supplies from the Bakken Shale to the US Gulf Coast. Energy infrastructure has become more of a political football than ever before. However, when you can't build more of something, whether it's cars, machinery, or in this case, absolutely vital energy infrastructure, the value of existing infrastructure increases dramatically. That's why Roger and I are so excited about a handful of out-of-favor energy infrastructure stocks that control the vital means of transporting and storing increasingly valuable energy commodities. So there you have it. We've covered a lot of ground in this video presentation today. I've explained why the recent sharp rise in European natural gas and electricity prices is due to the undeniable failure of the region's alternative energy push. Why weather-dependent solar and wind power technologies cannot replace the need for reliable natural gas, coal, and nuclear power plants for the foreseeable future. Why the timetable of rapid energy transition away from fossil fuels in favor of alternative energy has failed miserably. I've explained how well-meaning but unrealistic government policy initiatives have starved traditional energy producers of capital, leading to a fast-emerging shortage of oil and natural gas supply over the next few years. An energy crisis that's feeding inflation rates we haven't seen in the developed world in nearly 50 years, and destroying the purchasing power of our savings and investment dollars. I don't have a specific political agenda. Rather, I'm just following the facts, and I believe my conclusions, while downright terrifying in some cases, are inevitable. I've also outlined 5 specific profit steps I'm recommending my readers take, starting immediately, to protect and grow their wealth through the coming energy crisis. I'm so confident in my conclusions that I'd like to invite you to review all my research and specific energy stock and exchange-traded fund recommendations with absolutely no risk or obligation as part of a limited-time, risk-free trial to my Energy and Income Advisor publication. I'm not asking you to commit to anything today. Simply click the button next to this video to start your risk-free 90-day trial. Each month, you'll receive detailed issues of Energy and Income Advisor that highlight specific trends my colleague Roger Conrad and I are following in the energy markets. We also offer updates to our model portfolio of stock recommendations that include specific advice on which stocks and ETFs to buy, how much to pay for those stocks, guidance on suggested position sizes, and, most important of all, advice on when to sell. Plus, a constantly updated list of dangerous stocks that appear to offer the allure of sky-high dividends, but are really just income traps that will burn many investors. And every month, you'll also receive an exclusive invitation to our monthly online Q&A chat. It's the most popular feature of our service. Simply put, you'll be invited to ask any question you like about the markets, energy prices, or specific stock recommendations, and Roger and I will answer those questions live on the monthly chat. In short, try all of what Energy and Income Advisor has to offer for the next 3 full months, and only then decide. If you don't agree it's worth every dime of the subscription price, Simply call us and cancel your membership for a full refund of your subscription price with no questions asked. I guarantee it. And for a strictly limited time, we're offering Energy and Income Advisor at the lowest price we've offered in nearly 8 years. Right now, you can start your membership to Energy and Income Advisor with a 90-day risk-free trial at a cost of just $649 per year. I simply can't afford to extend this offer for long. And once it's gone, once I take this video presentation down, it'll be gone for good. And frankly, with energy prices and inflation increasingly in the news, I just don't believe the value I'm seeing today will be available for much longer. So I urge you to accept this deeply discounted risk-free trial offer to Energy and Income Advisor today before it's too late. I know in my heart that it will be the best financial decision you could make. To start your risk-free trial today, simply click the button next to this video presentation or give us a call, toll-free on 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Thanks for listening today, and here's to your wealth. To start your risk-free trial today, simply click the button next to this video presentation, or again, you can give us a call toll-free on 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Thank you very much, and here's to your wealth.